Aloha, inspired moneymaker. I'm so glad you're here. If this is your first time joining us, welcome. If you're a returning viewer or listener, welcome back. Let's make the most impact with our money together. Today, we're talking about one of the most powerful wealth building tools out there, real estate investing. Now, I'm not a real estate guy, so I'm going to confess to you right now, one of my biggest regrets was not selling or not holding on to. I sold a condo in Brookline, Massachusetts back in 1998, and I wish that I held on to it and rented it all these years. I bought it at a great price, and it has appreciated so much. I don't even look back to see how much it's gone up, but I definitely left a lot of money on the table. Because I've been a stock and bond guy for the last 30 years, I'm excited to host this panel of real estate experts today. By the way, this is our 4th episode on real estate in this 100 episode series of Inspired Money Live. If you put inspiredmoney.fm/live100, that's live 100, into your browser, you can find all of our previous episodes. There are lots of gems in there, everything from investing for growth to philanthropy to collecting classic cars. There's going to be something for you. Episode 52, Navigating Student Loans, is a favorite of mine. I think it deserves more downloads and views. If you missed that one, definitely check it out. Okay, on to today's real estate episode. Today, we're going to be covering how to get started, what makes a great rental property, how do you find deals that actually work, financing strategies from traditional loans to creative funding, how do you structure your deals for success, in scaling your portfolio, how do experienced investors grow their holdings while managing risk? So whether you're looking to buy your first rental property, expand your portfolio, or navigate today's challenging market conditions, this episode is packed with actionable insights. We're going to be bringing in the experts, seasoned investors who have been through market shifts, refining their strategies. They can tell us what to look for, what challenges to expect, and how to build long-term passive income through real estate. Before we get started, this episode of Inspired Money is brought to you by Seeking Alpha Premium, your go-to resource for making smarter investment decisions. With Seeking Alpha Premium, you'll get access to in-depth stock analysis, quant ratings, and 24/7 market coverage from thousands of investors and analysts. Whether you're a long-term investor or just getting started, you'll see both the bull and the bear perspectives to help you make informed decisions. Right now, you can try it with a 7-day free trial and get $30 off your first year. After the trial, it's $269 for the year, renewing at the current annual rate. So just so you know, this is an affiliate link. If you subscribe, Inspired Money may earn a commission. It's a great way to support the show. So ready to take your investing to the next level? Go to inspiredmoney.fm/trial30, that's trial 30, to claim your free trial and $30 off Seeking Alpha Premium. Terms apply. Cancel anytime before the trial ends to avoid charges. Happy investing and stay inspired. Let's bring in our guest panelists. All of our experts are here. Kathy Fettke, welcome back. She is a real estate investor, educator, and co-founder of Real Wealth, where she helps investors build passive income through smart real estate strategies. She's the author of Retire Rich with Rentals and co-author of Scaling Smart, How to Design a Self-Managing Business, as well as the host of popular podcasts, that's podcasts with an S, The Real Wealth Show, and Real Estate News for Investors. Kathy, welcome back.
This wonderful panel.
Awesome. We have Jason Hartman in the house, a guy who, in the back of my mind, I've been wanting to have on the show for a while now. He's a real estate investor, entrepreneur, CEO of Empowered Investor. He specializes in helping people build wealth through income property investments across the US. As the host of the Creating Wealth podcast and a sought-after speaker, he educates investors on market cycles, financing strategies, and long-term wealth building through his complete solution for real estate investor system. Jason, welcome.
Andy, it's great to be here. Looking forward to a good discussion today.
Likewise. You do some stuff with lifestyle too.
Well, yes, I guess so. I'm not sure what you mean by that, but tell me.
Oh, you left me a message that I just listened to like 30 seconds ago about doing some lifestyle like masterminds.
Oh, absolutely. Yes. My mastermind yacht adventures. That's what that was about. Yes.
That sounds fun. So I'll discuss that with you offline.
Sure.
We have Michael Albaum here. He is a real estate investor, educator, founder of MyFi Academy, specializing in long distance rental investing and financial independence. That's where the FI and MyFi comes from. He's the co-founder of Bold Street AI, providing data-driven insights for smarter real estate investments. And he's the host of the Remote Investor podcast, where he shares expert advice on building wealth through real estate. Starting as a fire protection engineer, Michael built a portfolio of 61 plus units using strategies like BRRRR and turnkey investing, helping others achieve financial freedom through informed decision making. Michael, welcome.
Thanks so much, Andy. Super happy to be here.
And rounding out our panel today, we have another podcaster, Monick Halm. She's a real estate investor, syndicator, and founder of Real Estate Investor Goddesses, a community dedicated to helping women build wealth through real estate. With over 20 years of experience and 350 million in real estate transactions, she's the best-selling author of the Real Estate Investor Goddess Handbook and Invest Like a Goddess. She's also a TEDx speaker and host of the Real Estate Investor Goddesses podcast. Monick, awesome to have you here.
It's great to be here. Thanks for inviting me.
So we've got an incredible panel that has, I would say, millions of dollars worth of combined real estate investing and real estate income firepower. Lots of stories and experiences to share, no doubt. Let's dive right into segment one.
Investing in rental properties requires careful selection based on financial goals, risk tolerance, and market conditions. Each property type presents distinct advantages and challenges that impact profitability. Single-family homes appeal to long-term tenants, offering stability but posing vacancy risks. Multifamily properties generate multiple income streams, reducing total vacancy exposure but requiring hands-on management. Commercial properties provide extended lease agreements and higher returns, though they demand significant capital and expertise. Vacation rentals yield higher short-term earnings, but fluctuate in occupancy and regulatory constraints. A strategic approach includes market research, location assessment, financial analysis, and regulatory compliance. Evaluating local demand, employment centers, and economic trends ensures informed decisions. A well-chosen rental property aligns with investment objectives, balancing income potential and operational complexity. Success depends on thorough preparation, identifying the right opportunity, understanding market conditions, and executing a structured investment strategy.
Kathy, if you can kick us off, you've helped thousands of investors get started. Looking at the market now, what specific economic indicators should investors focus on in 2025 to find rental property opportunities?
Yeah, a lot of people think that now is a more challenging time than ever, and that may be true due to high interest rates and high home prices. I can tell you, I don't think it's ever been easy. So I'll say that if you want to be a real estate investor, you've got to be really committed, and there's and to answer your question in terms of opportunity, looking at the big picture in single family rental housing, there is simply not enough. And I'm sitting here in the Southern California area, and when you have a major disaster like the Palisades fire and the Eaton fire, then that is even compounded, that issue. So I just was telling my daughter that the value of her home just went up because simply there's just not enough inventory out there, and it's difficult to build in a place like California. So, but this is across the country. The builders have just not kept up with growth. And we have a very large population of millennials who are at home, first-time home buyer age, forming families, having children, animals. They'd like to have a home that they can live in with a fixed rate that they don't have to worry about their rents going up all the time. And the problem is affordability, which leads to, from the investor perspective, the opportunity to provide that rental housing to this huge group of millennials.
Thanks for the perspective that it's never been easy. Jason, your Hartman Risk Evaluator helps investors evaluate markets. Can you walk us through how it applies when selecting a first rental property?
Yeah, I think the Hartman Risk Evaluator is just a really good way to understand the real value of anything. And, we apply it to real estate because everybody, when they try to understand the cost or the value of something, they do it in only one item, and that is US dollars. And that is a mistaken way to do it because US dollars are a moving target. And so if we compare it to 40 other things like, well, hey, what's in the news now? Eggs, right? If we compare it to eggs or gold or orange juice or the cost of any of these other commodities, we can really arrive at a truer understanding of whether something is cheap or expensive. And that's one of the things that the Hartman Risk Evaluator helps people do.
So it's a way to be more comprehensive and more systematic in doing a comparison?
Yeah, because you can't, priced in different commodities, you really start to understand the value of something. Whereas if you just use dollars, that would be crazy because if you look at real estate appreciation over time, historically, inflation, of course, destroys the value of our savings, our stocks, our bonds, and even our equity in real estate because it's denominated in what? Dollars. Now, residential real estate only outperforms inflation historically by a small amount. So we have to look at the value in real terms, and that's why we compare it to a lot of other things rather than just using dollars.
Very helpful. Michael, you're a proponent of long distance investing. For someone new, what's the single most important factor when choosing an out-of-state property?
Yeah, it's such a good question, Andy. And I think it's something that a lot of people have a really difficult time wrapping their heads around because they've never been to a location. How could they possibly imagine owning something? So I personally, I'm a big believer in affordability. I'm a California native. I've been living in the Bay Area a long time. I grew up in Southern California, and investing in my local market just was never an option for me because of the affordability issue. But when I went across state lines, I just happened to realize that I could, based on my current financial conditions, afford to buy something and rent it out, which was what led me to get my foot in the door to start down this path towards financial independence and real estate investing as a career. So I think picking a market that you can simply afford and start from there is a great place for people to get started.
Affordability is that's a very important factor. So let me ask Monick, for those who might lack the capital to buy a property of their own, how can they leverage partnerships or syndications to enter the rental property space?
That is also a great question because a lot of people, and I thought this too, I had this myth that I was limited to my own capital and credit when I was investing in real estate. And like Michael, I also live in California, a very expensive market, and that was very limiting. But when I learned about the value of partnering with other people, so one of the main ways I invest is I bring groups of investors together to purchase larger commercial properties. In essence, we're crowdfunding real estate. And you can have a little bit of a little piece of the pie, but you can own and you get your proportionate returns and tax benefits and all. You can enjoy the benefits of real estate without having all of the money by yourself. So you can do it in the sense of a syndication as a passive investor. You can partner with other people. It can be a small group of you who got your tax returns, and you like 4 or 5 of you get together to purchase a property. So there are a lot of ways in which, together you can with others you can get in the game.
Kathy, you also work with investors to help them to do that. Can you share some insights in how you find, attractive deals?
Yeah, investing in syndications is generally for accredited investors. So I just want to start with that. That basically means that you either have $1 million net worth, $200,000 in personal income, or if you're married, $300,000. Some of those rules may be changing now with the new administration, so stay tuned on that. And some syndications do allow non-accredited investors, but you do have to still have the means to be able to invest in syndications. I generally recommend getting into owning building your own portfolio first, because just to the question before, how do you get in when you have a little money? You can get a 3% down loan as an FHA loan when you're just starting out. So there's other places to look than syndications generally for a return. But with that said, there is opportunity today in apartments, because the prices are down now because interest rates went up. So that's an opportunity for us. We are doing build to rent communities because of the tremendous demand I said earlier of millennials who would like to live in a home. They just may not be able to buy it. So we're building those homes for them. And investors can either buy a brand new property, rent it out themselves, or invest in our syndications where we do all the building and the renting and the managing for them.
So I hear the need for being adaptable and for making adjustments. Let's go. Oh, sorry, go ahead.
Yeah, I was going to say, no advice is going to be necessarily right for everybody. So if you're starting out and you have a little bit of money, you're going to have a different strategy than someone who's maybe later in life and has a whole bunch of money and just wants it to be more secure. So really understanding your strategy. Are you looking for cash flow? Are you looking for growth for the future because you already have a job and you have enough cash flow? Designing your personal strategy is the number one step.
Thank you. We're going to go to segment 2 and talk about financing.
Financing rental property investments requires selecting the right strategy based on financial goals, risk tolerance, and market conditions. Traditional mortgages offer lower interest rates but require strong credit and higher down payments. Private money lending provides flexibility and faster access to capital, but may come with higher costs. Hard money loans are short-term solutions suited for investors planning quick renovations and resales. Seller financing allows buyers to make direct payments to the seller, bypassing traditional lenders. Lease options give tenants the opportunity to buy a property after a set period while renting. The BRRRR strategy, buy, rehab, rent, refinance, repeat, enables investors to scale portfolios by recycling capital. Choosing a financing method involves assessing loan terms, approval speed, and long-term investment plans. Comparing multiple options and structuring deals effectively can maximize returns while managing financial risk.
Jason, you mentioned inflation earlier. And inflation, I've heard you say, can be a hidden benefit for real estate investors. How can investors leverage that when securing financing today?
Oh, inflation is not to be underestimated. It is the greatest thing for real estate investors, especially when you use financing. Now, traditionally, every investor will tell you real estate is a great hedge against inflation. We've all heard that a zillion times. And that's because the value of the property will typically outperform inflation by a small margin. But that's not really that great. Let's add 2 more things to it. Number 1, leverage. So when we leverage our properties, we get a multiplier effect on that appreciation. So say, for example, real estate in a really good year is outperforming inflation by maybe 5%. Okay, so if you leverage that property and say you put 20% down and you finance 80%, now you have a multiplier. So that 5% differential that you were getting now turns into a 20% differential. So that's great. But wait, there's more, as they say on late night TV, on the infomercials. The debt, the value of the debt in terms of the balance of that mortgage and the monthly payment on that mortgage is constantly being debased or attacked by inflation. And this is good for us as investors because we borrow based on today's dollar value, but we pay back based on the future dollar value, which as long as we have inflation is lower. And I doubt there's anybody who could argue that we aren't going to have significant inflation in the coming years. There may be ups and downs in that over time. There will be recessionary periods, of course, but the long game is inflationary. And that inflation basically pays our debt down for us. I call this inflation-induced debt destruction. I know it's a mouthful, but that's really what it's doing. It's debasing and destroying the value of that debt. And if we owe money and we're the debtor, that's a wonderful thing for us because inflation is paying it back for us. Here's an example. Say, for example, just for round figures, a real estate investor has $1 million in mortgages. Say they bought, from my company, they would buy maybe 4 turnkey houses, and they would have a $1 million total mortgage value on those 4 properties. If we have 10% inflation, whether that takes place in 1 year, 2 years, or 3 years, inflation basically reduced the value of that debt by $100,000. Inflation basically paid off $100,000 of the investor's debt. So it's a phenomenal hidden wealth creator.
Very powerful. Yeah. So you can spend more, you can spend stronger dollars today and pay back with weaker dollars tomorrow.
Yeah, that's a beautiful thing.
Kathy, for first-time investors, since we are seeing higher interest rates than a couple of years ago, what do you see? Are financing options less accessible? How have things changed in 2025?
Financing is accessible, probably more so than ever, because I think the banks would really love people to borrow money. It's just that the rates are higher, but not really historically so. When I started investing, I remember my father was so thrilled when we got into the single digits. He had been owning rental property over 10% for years, since the 80s. And so anything under 10% I consider great. What's difficult is that also home prices are at historic highs. So when you have that combination, it's harder to get cash flow these days. If you're investing strictly for cash flow, it's going to be a little bit harder, and it might require you finding an older property, fixing it up, building in that equity. You might be in a less growth area. Some parts of the country just never see prices go up, and as a result, there's more cash flow, but you're choosing cash flow over growth. So understanding your strategy is really important. As far as I look at it, if you're buying for buy and hold as a rental property, the goal should be to hold, and that this is an investment property that you're buying in a growth area where the tenants are paying down your debt for you. You're getting government incentives, massive tax breaks for doing this, for providing the housing. And over time, you will become very wealthy as a result, because in time, you'll own that property close to free and clear. It'll be paid down for you, plus most likely will have gone up at least 3 to 4%. I don't know any other investment that offers you those kind of advantages.
Yes. So define your objectives very clearly at the outset.
Just, one thing, Andy, you might want to add to what Kathy said, because she was exactly right. But she did say that interest rates are high. And, that is true compared to how we got so spoiled during the COVID era. Rates are definitely higher. Yeah. Historically, they're low. They're not that high at all, really. When I got into the business, rates were 14%. Everybody thought that was a bargain because it used to be 18 or 20%. But here's the thing. What you have to do when you're really understanding the interest rate that you are paying, or really your tenant is paying for you, because they pay the mortgage. Okay, that's the idea. You outsource the debt responsibility to the tenant, but you have to subtract the cost of inflation and the benefit of the tax deductibility of that mortgage interest. So when you subtract those two things, that interest rate is really quite a bit lower than you might think. So let's take an example. Say, for example, an investor's paying 7% on a mortgage. Well, I think we listen to the government statistics. Of course, they understate inflation, but let's just say inflation is 4%. So now our net is really only 3% in terms of the net interest rate we're really paying after inflation is subtracted. Then we subtract the interest on that mortgage, and that'll give us, depending on our tax bracket, maybe 1% or up to like 1.5% if we live in the Socialist Republic of California, right? We get a bigger tax bill, so we get a bigger tax deduction. So really, in that example, someone might only be paying 1.5% interest after inflation and tax benefits. It's not as bad as you think.
Excellent perspective. Monick, what do you see in your community of real estate investing goddesses.
Or what do I see in terms of them being able to get into new properties right now?
Yeah, financing. I didn't know, like,
Yeah.
for example, do you see a need for creative financing strategies if people can't qualify for traditional bank loans, things like that?
Yeah. So there are so many different options the great little video shared some of them, right? From there's the traditional bank, but there are hard money, there are non-qualified mortgages, which are and there's seller financing. One of the things that is really interesting right now is a lot of the non-qualified mortgages, these debt service coverage ratio loans, which are based more off of the income of that property as opposed to the borrower's personal income and debt. Those interest rates are very similar to traditional bank financing. So what this allows is a lot of borrower or investors who might not have been able to, who would want the much lower interest rates. They're able to get into these debt service coverage ratio loans, these DSCR loans, for around 7 to 8% in a lot of cases. So a lot of these non-traditional options are becoming more affordable relative to conventional loans. So that's something that a lot of my goddesses are pursuing.
Michael, you've used the BRRRR method extensively. How can investors decide when short-term financing like hard money loans is the right choice compared to a traditional mortgage?
It's a really good question. I think it really all depends on the need and easeability and then ultimately price of those dollars. So if somebody is going to go get short-term financing, depends how fast they can get their construction project done, how fast the eventual refinance at the end of that R is going to be in the BRRRR method. Something that I've seen and I've personally done, and I think is a phenomenal strategy, is we've seen incredible, unprecedented appreciation over the last several years. And so people have massive amounts of equity in their either primary homes or rental properties. And so leveraging a home equity line of credit on either a prime residence or an investment property can be a really great way to access kind of your own hard money, so to speak. But you have to understand the consequences and the ramifications of not paying the loan payments back on a HELOC that could be on your primary residence. So it's all about understanding risk tolerances, understanding what the term and length of the time you need that money is, and then what the exit strategy is on the back end. That's going to kind of help us reverse engineer into what type of financing we should be using for which type of project we're doing.
And I'd just like to add on to that a lot of people who don't invest in real estate don't understand how quote unquote easy it is to get an investment property loan, not from a regular bank, but from banks that specialize in working with real estate investors. We're allowed up to 10 Fannie or Freddie backed loans. That's loans that are backed by the US government. So that just kind of shows the US government wants us to own rental properties. It solves a problem. It offers housing to people, and we're incentivized for that. And you don't have to own your primary first in order to have investment property. So a lot of people don't understand that. If you're from California and you want to buy a home and it's $1 million, you might not be able to afford that. That's a very high down payment you might have. But you could forego buying your primary and rent in California and then invest, say, in Texas, where you could buy a home for $200,000, which would be a $40,000 down payment. Or move temporarily to somewhere else if you're not working at the time, and you'd only have to put 3% down if it's your primary. That's doable. So, like I said, it's never been easy, but you just have to be creative and committed. And once you get in, and once you start to see the growth, the fact that your properties are increasing in value, and someone else is paying off your debt for you. It's like I describe it in my book, Retire Rich with Rentals. Let me say that again, Retire Rich with Rentals, get that out of my mouth. It's like having golden geese, the old story, the golden goose. You have lots of these little golden gooses creating money for you while you're not actively working on that property. You could focus on your career, the thing that you do, and have these other assets building wealth for you while you sleep.
Yeah, it helps to talk to a lot of people because I want to share really quickly that several of my clients who were looking for a quick loan, they've been able to use asset-based, I think they're asset-based lines of credit, where if their account is at Fidelity or Schwab, the Fidelities or Schwabs of the world also have partnerships with banks like Goldman Sachs or US Bank, where a client can use their portfolio of stocks and bonds and then get a loan from the bank. And it all happens pretty quickly with not a lot of paperwork. It gets approved, and then they have platforms that are electronic where, all parties can log in and see what is the amount borrowable and what's the rate. And then if you take the loan, you can see that loan balance and see it paid down as well. Let's go to the next segment. We're going to talk about managing rental properties.
Maximizing rental property profitability requires structured management practices. Choosing between self-management and hiring a property manager depends on time, expertise, and property scale. Self-management reduces costs, but demands hands-on involvement, while professional managers handle operations for a fee. Tenant screening ensures reliable occupants through background checks, credit history, and rental references. Lease agreements must clearly define terms, payment schedules, and responsibilities to prevent disputes. Rent collection strategies, including automated reminders and multiple payment options, improve cash flow consistency. Regular property maintenance preserves asset value and tenant satisfaction. Preventative repairs, scheduled inspections, and prompt responses to issues reduce long-term costs. Strategic upgrades, such as modern appliances and security enhancements, can justify higher rents and attract quality tenants. Effective management strengthens cash flow, minimizes risk, and enhances long-term investment returns, ensuring rental properties remain competitive in changing market conditions.
Monick, what's your best advice for hiring and managing property managers? What's been your experience?
Definitely in your question, I think is the answer. You need to manage the property managers. So what is a mistake is hiring a property manager and just going, okay, I'm sure you're going to take care of everything, and not having proper oversight of that property manager. So I think having the right oversight and management with that manager is really important. And also, you're only as good as your weakest link. That a good property manager is worth their weight in gold, and a bad property manager will sink your deal. So it's really important that you do proper due diligence before you get that property manager, and then you just stay on top of the management of the manager during your ownership of that asset.
And if I could just add on.
Oh, yeah, go ahead.
Yeah, just adding on to Monick's point, I agree 110%. And I think it's so important to screen multiple property managers in a particular market before you're getting involved in a deal, to make sure that that's a market you want to invest in, to ensure that you've got the support network and team behind you. It's kind of like dating. People have always said, you date an agent, you marry your property manager. They're going to be with you for the long haul. And to Monick's point, 100%, they are the success or the failure of the asset that they're managing. So don't sleep on interviewing and screening property managers. And it's something that we help a lot of folks do over at Bold Street.
Jason, you've experienced market shifts and changes across tenant behavior. How do you recommend landlords proactively adjust their management approach to remain profitable?
Well, first of all, let me say that the vast majority of property managers absolutely suck. I mean, they're terrible. And I knew everyone would get a laugh out of that, because I know everyone has lost money because of property managers. It is just one of these industries that seems to be a bad industry, full of just bad people. Honestly, I mean, there's some good ones, but there's not many. Okay, so if you find a good one, like one of the other panelists said, they're as good as gold. But it is tough to find a good property manager. You constantly have to manage them. You have got to pay attention to everything they're doing. You've got to look at your bills. You've got to question your bills. You've got to make that property manager know that you are paying attention. We recommend, though, that people self-manage. And if you told me I could self-manage a long-distance property years ago, I would have told you you're out of your mind. But you can, and I've done it many, many times. You can self-manage with the right tools, the right techniques, the right training, and we help people do that. You can self-manage your properties, and all of our clients who are doing that are very happy with it. We, of course, do try to find and recommend the best property managers out there, like everybody else in the group does. But I tell you, self-management is where you really get empowered as an investor. That's my company name, so throw that out there. We'd recommend self-management the most. But of course, there are techniques to manage your manager too.
Kathy, are you self-managing any properties?
You know, I'm not right now, but there are more technologies today than there used to be. At our company, at Real Wealth, we have sourced many property managers around the country who do a great job. But Jason and I have been around long enough to know that even the best property managers can implode. So it may be because they grew too quickly and they didn't hire enough. There's a lot of questions you should ask your property manager before you hire them, and then stay on top of it during your long-term relationship. So a property management company might be great in the beginning, but as I said, they might run into issues if they grow too quickly, or if there's a staff change and they just can't, they're not the same company. We have a long list of questions on our website at Real Wealth that you could ask your property manager. One of them would be how many properties does each staff member manage? So within our network, we like to see 50 properties per staff member. If they have one person managing 200, let's say, they're not going to be able to do the job for you. And oftentimes when a property management company grows too quickly, then they get desperate and start to dip into those deposits. That's your money. And I've seen this happen, and then suddenly it implodes and they go bankrupt. So the minute you smell something, if you're starting to not see your rent come on time, then you should be asking questions and paying attention to your property. We're talking about managing your property managers, but you also need to manage your portfolio. And I've had investors, we have over 80,000 investors at Real Wealth, so we have all kinds, but I've had some say, they'll finally call us and say, I haven't received rent in 6 months. Well, why are you telling us this now? We should have known it if it was a week late, right? So then we can kind of find out what's going on with this company. So just to say you need to manage your property manager can be confusing for someone new at it. I would say get educated very quickly on property management, so that whether you're doing it yourself or using a company, the questions to ask.
One thing that might be also helpful there is, I think, we're all veterans, so we all know that property managers are mostly awful, and and that's just the way it is. It's just a bad industry. Hopefully it'll clean itself up and they'll get better people in the industry, but for now, not too many are very good. But one thing you have to keep in mind is compared to what? On my show, I always say compared to what? And if you're comparing real estate to other investments like stocks or whatever else it might be, right? You are going to be getting constantly ripped off by people on Wall Street. It's just the way that game works, and there's a lot of middlemen taking money out of the deal, right? And so your property manager might be doing that to you too. But I just want to put that in perspective a little bit, because the asset with real estate is such a durable asset. It's the most historically proven asset class in the entire world. It's the most historically proven asset class historically, and it can stand a lot of abuse. Now, you don't want to get abused, right? But even though with real estate, you're going to feel those bumps in the road because you don't have a CEO at NVIDIA managing it for you, right? But believe me, there's a lot of bumps going on behind the scenes in NVIDIA that you don't even know about and you don't even think about as an investor, that are reducing your return on investment. Okay, so I just want to keep that in perspective is all.
Excellent perspective. Michael, any comments on technology and systems that help you to manage rentals from far away?
Yeah, so the only rentals that we self-manage are the old primaries that we moved out of and then converted into rentals. So everything else that I have at a super long distance out of state, I have managed by property managers, long-lasting relationships that I built over time. To everybody else's point, a lot of them took a long time to build and they were pretty bumpy. I think there's a ton of great technology out there. I personally am kind of a low-tech person when it comes to managing my properties. Partially one, because I know the property so intimately well, and I know the network of vendors that I need to call if anything goes wrong. So I'm using a software to collect rent, and I'm using a software to screen tenants. Other than that, I'm pretty old school. I pick up the phone, I send emails, text message, that sort of a thing. But I know that there are tons and tons of great platform and tech stack out there.
Monick, similar for you?
Yeah, so I have, for the most part, third-party property managers, especially because most of our investments now are larger properties, so industrial or multifamily, and I'm not managing them hands-on. But we have, various tech that that our property managers use to manage those properties.
Okay, so maybe we can go around really quickly because it sounds like a good property manager will make you. A bad one could break you. So
100%.
given your experience, all the panelists, what's your advice for people or any cautionary tales of mistakes to avoid? I don't know. How about Jason go first?
Oh gosh, I mean, like anything, real estate has all sorts of pitfalls, right, that you can fall into. So build a team, have good advisors that aren't necessarily attached to like any one deal. That's one of the things we like to say, is that we are area agnostic. Of course, we'd like your business. We'd like you to be investing through Empowered Investor, but we're not attached to any one market. So that detachment helps us be more objective. And so, just have a team of people you trust around you. Undoubtedly, that team is going to change over the years, and just get good advice, and be careful, like anything. But don't be so careful that you don't do it. Okay, it takes. I mean, it's so interesting because ever since I really started doing YouTube and dedicating more resources to YouTube, it's different than I've been podcasting for 20 years. But with YouTube, people make lots of hit and run comments, right? They don't do that on podcasts because that's not the way the platforms are designed. And, I just remember all of these doomers that have been saying things on my videos like, oh, this isn't going to age well. Well, they said that 5 years ago. They said that 4 years ago. They said that 3 years ago. They said that 2 years ago. They said that a year ago. Home prices are still going up. People are still making money, and these idiots are missing out. If you listen to doomers, okay, this is the biggest cost and the biggest mistake you could make. I remember we were doing a live stream recently with Peter Schiff. He's a famous guy. He's been on my show. Everybody knows who he is. And, he's really smart and he sounds really good. But one of the comments that came in on the live stream I thought was hilarious. It said, as Peters was talking and saying everything, someone commented, Peter Schiff has been wrong since 1982. and he's right. All of these doomers that talk people out of things, those are the ones costing you the most money. You can get into real estate. You can make lots of mistakes. You can have bad property managers. You can get screwed over, and you will still beat the person who didn't do anything. That person loses for sure. You got to get in the game and you got to just make the best of it. You're going to make mistakes. You're going to have experiences. They're not all going to be good. You're going to feel the bumps in the road, but the persistence and the courage to keep moving forward, that's the person who wins.
It pays to have a brand. I think the doomers, if you're doom and gloom all the time, usually they have a pretty good brand. The news always knows.
The doomers get way more views. By the way, they have
exactly.
way bigger audiences. If I was a doomer and if I was saying everything's crashing, I would have way bigger audience. Okay, no question. They always.
All right, I said we were going to go around.
The human mind looks for negativity. That's the way we're programmed because that's what allowed us to survive for eons. But we are now, since the Industrial Revolution, living in a world of abundance. That survival mentality doesn't really serve us very well anymore.
I said we were going to go around the panel. I lied. I'm going to pivot. Let's go to the next segment.
Identifying profitable rental properties requires a data-driven approach. Market indicators such as job growth, population trends, and rental demand provide insight into long-term investment potential. Emerging markets with economic expansion and infrastructure projects may offer strong appreciation, while saturated markets present stable but slower growing opportunities. Financial metrics help assess risk and return. Rental yield measures income potential relative to property value, while cap rate evaluates profitability after expenses. Higher yields and cap rates may indicate better returns, but require careful risk assessment. Due diligence is essential. Reviewing financial records, conducting property inspections, and verifying legal compliance help mitigate investment risks. Analyzing lease agreements and maintenance history ensures a clear understanding of future obligations. Successful investors combine market research, financial evaluation, and thorough property analysis to make informed decisions, maximizing long-term profitability while minimizing exposure to financial uncertainty.
Kathy, you look at a lot of economic trends. Are there specific data points you monitor to predict the health of rental markets?
Yeah, absolutely. We want to be in areas that are growing. That means that there's population growth, job growth. We do not want to be in areas where people are leaving, right? And that can be just neighborhoods within an area. You might pick a wonderful market, like let's say Dallas, Texas, but there will be pockets where it's not going to make sense for you. So everything that last video just showed is what I would answer the last question of what mistakes can you make? It's that. It's not understanding the dynamics of the market you're investing in. I've had too many people come to me and say, what do you think about this property I just found online? And that doesn't tell me enough. Where is it? Is it out in the boonies? If it's out in the boonies, where's your rental demand? Who's going to rent this place? Is it in an area with high crime and you're not going to be able to rent it because nobody wants to live there? You need so much more information than just a pro forma, a spreadsheet that shows potential income. You need to know how old this property is and if it's going to need a lot of repair, or is it brand new and it's not going to need any? Is it in the path of progress, or is it in an area where the major employer already moved out? Or you're dependent on one employer, like when I made the mistake of investing in North Dakota, that's dependent on the oil industry. And what if suddenly oil prices go down and jobs are lost? So this is very, very important. If you are a high net worth person, it's even more important that you do your due diligence. When you're just starting out, a lot of us just started out and guessed, and we made mistakes and, maybe lost money. But there wasn't a lot of money to lose, right? There wasn't a lot that you could be sued for. But as you become higher net worth, I've seen doctors put $1 million into a syndication where they didn't do the most basic due diligence of, oh, this property is in a really bad area. No one's going to want to live in it. So you've got to get educated. That is the biggest mistake people don't make, is jumping into something they don't understand.
Jason, you warned us of the doomers. I've heard you talk about the importance of identifying linear, hybrid, and cyclical markets. Can you talk about how that comes into play for an investor's consideration?
Yeah, sure. So most people in the real estate world pay attention to what's called cyclical markets. In the cyclical markets, they get all of the publicity, they get all of the attention. They're places like the West Coast of the United States, the Southeast Florida, the expensive Northeastern markets, and around the world, there are places like Hong Kong, Dubai, London, Paris, right? These are the markets that have very high prices and very high land values, and they have very bad rent to value ratios, which makes for good or bad cash flow because the rents don't keep up with the prices. So we like these markets that are linear markets, that are more stable markets where land costs are low and the overall house cost is low, and the rent to value ratio is very favorable for the landlord. They also happen to mostly be very landlord friendly from a regulatory environment. And so linear, cyclical, and hybrid are three types of markets that you can break down the entire world, the entire country with those three types of markets. Hybrid, as the name would imply, is in between linear and cyclical. Hybrid markets would be markets like Austin and Denver would be two that come to mind for me right away. But the rest of the country and the rest of the world, most of it is a linear market. It's kind of boring. Prices appreciate very slowly and in a linear fashion. They have minor ups and downs, but not major ups and downs. Whereas cyclical markets, if you're looking at a chart, it's like a roller coaster, ups and downs, right? Glorious highs, really ugly lows, but bad cash flow the whole time.
Michael, at boldstreet.ai, are you using technology to help evaluate and do some of that market analysis?
Yeah, absolutely. So we're leveraging AI in a pretty big way to go evaluate a lot of the market indicators and economic points that Kathy was mentioning. Where are people moving to versus from? What's the job growth look like? What's the new start look like for new development? So property expansion, building new homes, because the old school way of having to kind of Google market by market is, I think, a little bit antiquated. So we've found some pretty amazing tech to go do a lot of that researching for you, to do a lot of the analysis then for you and kind of spit out the answer, so to speak, of, hey, based on your investment criteria, we call that a buy box. Based on your particular buy box of what you're looking to accomplish and invest in, these particular markets, and even furthermore, these particular properties meet or exceed your criteria.
Interesting. So you can make more, I guess you can make more comprehensive research-backed decisions and do so more quickly.
Exactly.
Monick, for those interested in syndications, what additional market analysis factors should they consider compared to a traditional single-family rental investor?
Yeah, so with the things that we've talked, or Kathy was mentioning, still apply, right? Well, it depends on the type of investment, or if we're talking about, let's say, residential. When we're talking about industrial, things are a little bit differently, but you want to look at the market and the where job and population growth, the landlord friendliness, and just what are the trends and what's happening. And I love too that AI is helping make that process more seamless. The thing that I would add with syndication that's different. So it's really important that we look at the market and a location, because the market is definitely more important than the individual property. But what's most important when you're talking about syndication is the team. It's who is going to be managing that asset. So your as we were talking about with property managers, your team will make or break your deal. You do need to be in a place where the market makes sense, the fundamentals make sense. But with the syndication, especially if you're a passive investor and somebody's going to be managing it, you have to assess the strength of that team, in addition to all of the other factors that we were discussing.
Thank you. Let's bring it home. We're going to go to segment 5.
Expanding a real estate portfolio requires strategic planning, financial discipline, and a strong support network. The BRRRR method, buy, rehab, rent, refinance, repeat, enables investors to recycle capital and scale efficiently, purchasing undervalued properties, increasing their value through renovations, and refinancing to extract equity, create a continuous cycle of reinvestment. A 1031 exchange helps defer capital gains taxes by reinvesting proceeds into a like-kind property, preserving capital for future acquisitions. Adhering to IRS timelines and working with a qualified intermediary ensures compliance. Building a reliable team, including real estate agents, lenders, property managers, and contractors, streamlines operations and decision-making. Managing risk through thorough due diligence, maintaining cash reserves, and diversifying investments safeguards long-term stability. Effective scaling strategies optimize returns while mitigating financial risk, allowing investors to expand holdings systematically and sustain long-term wealth accumulation.
Kathy, what's your view on reinvesting rental income into more properties versus using it for personal financial goals?
It just depends on your situation. So if you are in the growth stage, you are maybe younger, you're trying to build for your future, for your retirement. That's really what I see buy and hold investing for ultimately, is being able to buy properties that appreciate in value such that when you no longer want to work, you have all these assets that have increased in value and the rents have gone up as well. That to me is the key to that. But let's say that you are already wealthy and you're ready to retire now. When I say wealthy, I mean you've accumulated enough wealth that you want to live off that cash flow. Then you're done with the growth phase. But when you're in the growth phase, I started this career as a mortgage broker. I'm all about leverage. If you can borrow money to buy an asset, someone else pays that off for you while it appreciates in value and the government gives you tax benefits. Do as much of it as you can while you're young so that you have time to let it grow like a garden. As you get older, you don't have those 20, 30 years to allow properties to grow. That's the way I see it. I buy properties for 10, 20 years in the future. So I'm looking at something very different than what somebody might buy today for cash flow, because I want to be in a market where I know that in 10 years, or at least I have a pretty good idea, in 10 years, it's still going to be a good market. In 10 years, it's still going to be a good property. So I don't look at the day one numbers. I don't care. People get so concerned about, I got to get a discount on this property or else it's not a good deal. Is that discount going to matter in 10 or 20 years if the property's gone up 3-4% every year and you've doubled your money? So knowing your strategy is incredibly important. So yes, absolutely. If you're in the build stage, take your money, your equity out of the property and buy as many as you can.
Jason, what are some creative strategies for accelerating portfolio growth without taking on excessive financial risk?
Well, oddly, and it is counterintuitive, the least risky thing is to usually have more leverage and have more debt on the property, because the more money you have in the deal, the more risk you have as the investor. The more money the bank has in the deal, the more risk they have. So that's one really important thing to understand. It's counterintuitive. And if you really think it through, you'll usually get it. I'm happy to explain more, time permitting. But that I think would be the first thing. And then just buy your properties and hold them. Like Kathy said, a lot of money gets eaten up in transaction costs, and a lot of investors lose out by getting discouraged by little bumps in the road. And the real thing to do is be a buy and hold investor. That works the best. Flippers, that buy and flip properties, they have spending money. But the people who have the real wealth are the people who buy and hold. And so I would say that's important. You said creative, so I don't want to completely avoid your question. There's all kinds of creative things you can do with real estate. It's one of the most creative assets classes out there. And, you can do wholesaling, you can do creative financing, you can buy properties with multiple loans. You can do you can do lease backs. You can do master leases. You can do lease options. There's just a million different ways you can do things. I got started because I was interested in creative financing. The first real estate book I ever read was Nothing Down by Robert Allen. And there's just a lot of creative strategies out there. But the important thing is to do something, to get in the game. So if you're listening to this and you're new and you're thinking about it, get in the game. That's the most important thing. Doesn't much matter how you get in, be in the game. And a lot of opportunities will present themselves. And if you've got a portfolio, you're probably seeing that this works very well. So get more properties.
Get in the game. Monick, what's the biggest mindset shift that you think investors need to embrace when transitioning from owning 1 or 2 properties to starting to scale their portfolio?
That is such a great question. I think the biggest shift is that it's possible for them, knowing that you can see when I had this shift, and I started with 2 doors, and then I never even thought it would be at all a possibility that I could have an apartment building. And then just learning that, yes, I could get into apartments. And then the first year that I learned about this, I was able to go from 2 doors to over 1,000 doors by, partnering with other people. I needed to just see that there was this possibility that it was something that somebody like me could do. I thought you had to be a billionaire to be able to do it. It hadn't even crossed my mind. So I think a big reason, and it's so great everybody here is a podcaster, because as we share these stories of possibility, as people see, oh, that person did that, maybe I could too. Then that's when the shift starts to happen. I think that's the biggest one, knowing that it's possible, and it's not just possible, but anyone can do it. There are so many creative ways to get in, and there are no limitations once you know, once you have a clear idea of where you want to go. There are strategies to get you there.
Michael, I think you're a relatively young guy. You're a new parent, so congratulations on that.
Thank you.
Wondering if you can share some insights into how investors can manage cash flow efficiently, like when you first started and then deciding to refinance and continue growing.
Yeah, so kind of like we've been saying all session here, that it just so depends on every investor's goal and their personal situation and where they're trying to get to. So I was someone, I think Kathy mentioned it, I was a renter for 7-8 years, owning investment properties, but I couldn't afford to buy my own primary residence, or I didn't want to, for that matter. And so I think it just depends and comes down to, what are you trying to accomplish? Do you need the equity to be pulled out of the property? Because you're probably going to cannibalize the cash flow a little bit, but could you go buy something else that between those two things, the sum is going to be greater than its parts? Does that make sense? Or maybe now you're in life mode, you've grown enough and you don't need to continue growing. And so you want to maybe leave equity in the property because it's going to cash flow like a beast. And now you get to live your life and not have to worry about continuing to grow. So it's a great question, and one that I think you got to look a little bit deeper to understand what makes sense for every individual.
Thank you. Anybody want to share a closing thought?
I mean, I think Michael just said it, is there's no specific advice that's going to be perfect for everyone. When I first started, I bought a bunch of cash flow properties, cheap little properties in the Midwest. They were great for cash flow. They never really went up in value that much. And then when then over time, I realized that they were older homes and they needed a lot of renovation, and a lot of the cash flow I got from those properties just kind of went to pay repairs. And so there wasn't an upside and there really wasn't cash flow. So over time, I've just learned to invest in quality properties and growth markets. That's what works for me. And then now at this stage in life where I'm close to retirement, I've taken a lot of those properties, the equity from them, or sold them. And I've got bigger, kind of more legacy properties that I'm doing short-term rental on. So like Jason said, there's so much creativity in this industry, and once you have assets, then you can be more creative. You could sell them, you could refi them, you could renovate them, you could put an ADU on it, you could short-term rental, mid-term rental. There's so many options, but if you have no assets, you don't have much to work with except, maybe cash.
Anyone else?
Like we've been saying here, real estate investing is not one size fits all. So depending on your personal goals, there are ways to do it, but it is something that I think everyone can get in their way and can benefit from it, from the cash flow, from the appreciation, from the tax benefits. And so I encourage everyone to get in this game in whatever way works best for you and will meet your goals.
Michael?
I think I just want to share that, like everyone's been saying today, education is so paramount and so key to doing anything, let alone real estate investing. So go look to understand both what the upside potential is, but also look to understand the downside, because the last thing I want to see is for people to get in this because they hear so many success stories and they hear that real estate is so doable, only to find out that it wasn't for them for whatever reason. So go get educated, and then go look to find the people that have what you don't, whether that's time, whether that's money, whether that's access to deals. If you're lacking in one of those three areas, and bring them into the fold. Do this with someone. It doesn't have to be, you don't have to be a lone wolf out there. It's been said a million times today, just go get started, take action and do something.
And Jason?
Yeah, income property is the most historically proven asset class in the entire world. It's the most tax favored asset class in America. Taxes are usually the largest expense anybody has. So learn how to save on taxes, buy income property, and you'll save on taxes. It's such a great asset class, and just do it. And if you're already doing it, do it more, because it is definitely the most proven asset class there is. And you don't have to believe anybody saying that. You can just look around, because all of us know people who have made fortunes in real estate. And they're just the constant examples reminding us of this. Sorry, I need to eat lunch. I'm a little hungry.
All right.
And so anyway, it's just a great asset class. Get started, and if you're already started, just keep diving in. It's been great for me. It's been great for so many people that we all know. So lots of examples of success out there.
Thank you. We're going to leave it there. We're going to let the Californians eat lunch. I will say that it's even worse on the East Coast if I haven't had lunch yet. And wow, this has just been an incredible discussion. We covered a lot of ground, from choosing the right rental properties to financing strategies, market analysis, and how to scale a real estate portfolio in today's market. So many takeaways. I think that for me, it's about getting started. That successful real estate investors, it's not about waiting for that perfect deal. That you have to be adaptable. So whether it's BRRRR method or creative financing or shifting investment strategies, whatever creativity is needed, the key is to stay educated, to take action, and to adjust to market conditions. So, Inspired Moneymaker, I want to leave you with a challenge for the week. Find one potential rental market that interests you and start researching. You can look at job growth, population trends, rental demand. Even if you're not ready to invest today, building your market knowledge will help you to spot the right opportunities when they come. Then share your progress with me. Tag me on LinkedIn or social media. Send me a message. I'd love to hear what you're working toward. A shout out to the Inspired Money team. Excellent segment edits by Bradley John Eaglefeather and graphics by Chad Lawrence. Let's once again thank our amazing panelists one more time. Our panelists are what make this show great, so be sure to follow them. Find more about Kathy Fettke at realwealth.com. Check out her books, Retire Rich with Rentals and Scaling Smart, How to Design a Self-Managing Business. Listen to her podcast, The Real Wealth Show, and the Real Estate News for Investors. For Jason Hartman, visit empoweredinvestor.com and jasonhartman.com. Listen to Creating Wealth podcast and learn more from Michael Albaum at MyFI Academy and boldstreet.ai. Be sure to subscribe to the Remote Investor podcast. And Monick Halm, visit realestateinvestorgoddesses.com. Go read her best-selling book, The Real Estate Investor Goddess Handbook, and Invest Like a Goddess. Watch her TED Talk, listen to the Real Estate Investor Goddesses podcast. Kathy, Jason, Michael, Monick, so many great resources that you shared today, and you guys have so many resources on your platform. So I encourage everyone to find and follow them. The next Inspired Money episode will be Retirement Income Strategies, Maximizing Returns for Financial Freedom. That's next week, Wednesday, March 27th. Our guests at this moment are Professor at the American College of Financial Services, Wade Pfau, Dana Anspach, CEO of Sensible Money, and veteran financial journalist
There's been a world
Mary Beth Franklin,
President
one
Trump
of the nation's leading experts on Social Security, Medicare, and retirement income planning. The fourth guest is TBA. See you next week. Until then, do something that scares you, because that's where the magic happens. Thanks, everyone.